You've spent 30, maybe 40 years saving for retirement. You've hit your number. You're ready to go. But here's what nobody tells you. The way most people structure their retirement income costs them between $200,000 and $300,000 over the course of their lifetime. I've seen this happen over and over again in my 25 years as a financial advisor. But today, I'm going to show you 3 simple fixes that can keep that money in your pocket. None of these are going to require you to take on more risk or completely change your plan. So, here's what most people don't realize about retirement income planning. You spend 30, maybe 40 years savings. You hit your number. You're ready to retire. Then you go and sit down with your financial advisor and they show you the plan. And the plan looks something like this. You've got Social Security, you've got your 401k, maybe you got your pension if you're lucky. And the advisor says, great, we'll just pull 4% a year from your portfolio and you'll be fine. But here's the problem with that approach. It completely ignores 3 massive risks that can cost you hundreds of thousands of dollars. So today, I'm going to show you 3 specific fixes that most retirees are missing. The first one is the tax bracket arbitrage strategy, pulling from the right accounts at the right time. Number 2 is avoiding the Medicare premium trap, managing your income to dodge the massive surcharges. And number 3 is the Social Security sequencing strategy, timing your claims to maximize your lifetime benefits. Hey, these aren't complicated, and you don't need to be a financial genius. But they can literally add hundreds of thousands of dollars back into your retirement. Let me show you exactly how each one works. Let's start with the first fix, the tax bracket arbitrage strategy. And I'm going to show you exactly what this looks like through a real client example. Here's how most people think about their retirement income. Hey, I've got money in my 401k. I need the money. I'll just take it out. Simple, right? Wrong, because every dollar you pull from your traditional 401k or IRA is taxed as ordinary income. So if you're not careful, you can easily push yourself into a higher tax bracket without even realizing. Let me show you what this looks like in practice. I had a client, we'll call her Dana. She's 68, retired, living on Social Security and pulling about $60,000 from her IRA. She came to me because she wanted to help pay for her grandson's college. She needed about $30,000 and she was going to pull it from her IRA. But here's what she didn't realize. That extra $30,000 withdrawal would have pushed her into a higher tax bracket. It would have triggered IRMAA surcharges on her Medicare premiums. And it would have made 85% of her Social Security taxable instead of just 50%. That one withdrawal would have cost her almost $14,000 in additional taxes and Medicare premiums. So, here's the fix. Instead of pulling everything out of one account, you create what I call a tax-efficient withdrawal sequence. You've got 3 buckets of money in retirement. Taxable accounts, like brokerage accounts, tax-deferred accounts, 401ks and IRAs, and tax-free accounts like Roth, IRAs, and HSAs. The key is knowing which bucket to pull from and when. For Dana, we pulled $15,000 from her taxable brokerage account, where she only paid capital gains tax at 0% because of her income level. Then we pulled $15,000 from a Roth IRA, which was completely tax-free. Same $30,000, but instead of paying $14,000 in taxes, she paid 0. That's the power of the tax bracket arbitrage strategy. You're not avoiding taxes. You're just being strategic about how you pay them. Now, before I get into fix number 2, I want to tell you about a resource I've put together for you. It's called the What Issues Should I Consider Before I Retire checklist. It's the exact same checklist I use with my private clients every year. It covers everything from cash flow to healthcare to tax planning, and it's designed to make sure you don't miss any of the critical decisions. You can download it for free using the link in the description below. Just click the link, download, and you'll have it in your inbox in about 60 seconds. All right, let's keep going. The second fix is all about Medicare premiums, and this is the one that catches almost everyone off guard. Most people know that Medicare Part B costs money, and right now the standard premium is about $185 a month. That's what most people pay. What they don't know is that if your income is too high, you can pay up to $628 per month per person. That's over $15,000 a year per couple. This is called the IRMAA, the Income-Related Monthly Adjustment Amount. And it's a hidden tax on your retirement income most people don't even see coming. Here's where it gets really painful. IRMAA isn't a gradual increase. It's a cliff. Let me give you an example. If you're married and your modified adjusted gross income is $206,000, you'll pay the standard Medicare premium. But if your income is $206,001, yes, just $1 more, your premium jumps over $2,000 a year. I had a client that sold some stock to pay for a renovation a couple years back. The sale pushed his income up by $3,000. It triggered IRMAA, and it cost him an extra $2,400 in Medicare premiums. He paid $2,400 to make an extra $3,000. After taxes, he actually lost money. So here's the fix. You need to manage your modified adjusted gross income, your MAGI, like it's the most important number in your retirement. And there are 3 ways to do this. First, use Roth IRA conversions in early retirement years before you turn 65. Get the money out of your IRA and into a Roth when you're in a lower tax bracket and before IRMAA even kicks in. Second, if you're charitably inclined and over 70 and a half, use a qualified charitable distribution. Now, these don't count as income, so they don't trigger IRMAA. And third, be specific about when you sell investments. If you need to sell stock, spread it over multiple years instead of just doing it all at once. The goal is to keep the income below those IRMAA thresholds, because avoiding that cliff can save you thousands of dollars every single year. Now, let's talk about this third fix. And this is the one that has the biggest long-term impact on your retirement income. It's all about when you claim Social Security. Most people claim Social Security as soon as they retire. They're 62, they're done working, they start taking benefits. But here's what that costs you. If you claim at 62 instead of waiting till full retirement age at 67, your benefit is reduced by 30%, permanently. And if you wait until 70, your benefit increases by 24% compared to claiming at 67. I had a couple come to me, they were both 64, and they wanted to retire at 65 and start taking Social Security immediately. Their combined benefit at 65 would have been about $3,800 a month. But I showed them something they hadn't considered. If they could delay claiming until 70, their combined benefit would jump to almost $5,400 a month. That's an extra $1,600 a month, every month, for the rest of their lives. And it's inflation adjusted. Over a 25-year retirement, that's almost $480,000 in extra income. So here's the fix. It's called the Social Security sequencing strategy. Instead of claiming Social Security right when you retire, you use your retirement accounts to bridge that gap. Here's how it works. Let's say you retire at 65. So instead of claiming Social Security, you pull from your IRA or your 401k to cover your expenses for 5 years. Yes, you're drawing down your portfolio, but you're also letting your Social Security benefit grow by 8% every year you delay. And here's the kicker. Once you turn 70 and claim that higher benefit, you can reduce how much you're pulling from your portfolio, which means your portfolio lasts longer. I know it sounds a little counterintuitive, but the math works almost every time. Now, keep in mind, this doesn't work for everyone. If you have health issues or you need the income immediately, claiming early might make the most sense. But for most people, delaying Social Security is one of the highest return, lowest risk moves you can make in retirement. So let's bring this all together. You've got your 3 fixes that can completely transform your retirement income. Fix 1 is the tax bracket arbitrage, pulling from the right accounts at the right time to minimize your tax bill. Fix number 2 is to avoid the Medicare premium trap, managing your MAGI to stay below the IRMAA thresholds. And fix number 3 is to use Social Security sequencing. Delay claiming to maximize your lifetime benefit. These aren't complicated, but they do require planning. And they require you to think about your retirement income as a system, not a pile of money you can pull from whenever you need it. Now, if you're sitting there thinking, okay, this makes sense, but how do I actually implement this into my situation? That's exactly why I created the retirement planning checklist I mentioned earlier. It walks you through every single decision you need to make before you retire. Cash flow, planning, healthcare coordination, tax strategies, all of it. And it's designed to help you avoid the mistakes that cost retirees thousands of dollars every year. The link below in the description. Go ahead, grab it, completely free. And if you want help walking through your specific situation, you can also schedule a consultation with me. We'll review your retirement income plan together and make sure you're not leaving any money on the table. Hey, I'm Tim Gardner. Thanks for watching, and I'll see you in the next video.